Welcome to today's market update. Here we are on the 15th of April, looking at an opportunity to learn from these conditions. Obviously, it's not ideal for the ego when you see a trade not working out, but just to remind you, in trading, taking a loss every once in a while is a part of the journey. So, this is an opportunity to talk about how to operate both from a offensive, like an attacking in a way, an action-based line of duty, I guess, or sorry, it is. I'm up late because of coding and stuff, as you heard me say before. So yeah, I'm just going to try my best to speak, and hopefully the best comes out. So you got two things you have to kind of keep above you, with you rather, whilst you're working through the predictions of the markets, and that's an offense and a defense. So the action taking side is to make sure that your charts are as well prepared as possible, and you're taking action in the right direction to make sure you're not taking any shortcuts and doing all the right things on the market. And that includes setting the right position size, knowing when your entry and exits are, and so on. Now, the defense is what happens when things go wrong. I made a video over the weekend to talk about where to set your stop loss, where to set your entry point, and the different risk reward ratios. And sometimes, if you say, for example, you put $10 over here, and price hits you down. Let me take a step back. If you put your entry over here and you set your target up there, and you only had one target and not multiple targets, for example, then yeah, price would have gone to a stop loss first. However, if you did a 1:1 ratio, you would have closed the target. So it all depends on your ability to read the market as well. So this Easter weekend, it kind of crumbled down, built up a little bit, and now it's finding its position to continue its what is now seemingly a dominant trend towards the downside. All right, so getting back to here, let's say you didn't want to take conservative profit. You wanted to follow my suggestion over here, and it went down to stop loss, and you feel a bit better about it. Let me tell you, back in the day when I was trading, a lot of the exchanges, Bybit, Binance, and so forth, they didn't have stop losses. So when price went down like this, bang, bang, and you missed closing the order, there were major chunks of my account or one's account that would disappear. And especially if you're using like 25x leverage, which I was dumb enough back in the day to use, or anything higher than that. So these days, at least, there are smart exchanges or exchanges that have kind of fulfilled the requirements of their traders, because again, it's in the exchange's best interest for you to lose money, because the more you lose, the more they gain, and so on. So they're not really built for you to win unless communities get together and kind of demand certain features. So back in the day, I didn't have a stop loss, and this would be traumatic. However, for those who set a stop loss every single time they open up a trade, and they do so in the right position, then there is just a little bit of bitterness for a minute. That's if you're not working on a 1:1 risk reward ratio during a ranging market with low activity. I would have suggested that, even though this was the prediction. But that's all kind of hindsight talk. Whilst the price is moving and such, you can't always distinguish what the best action is going to be at every moment. So let's just say no apologies, that didn't work out, and went bang straight to stop loss. All you're really risking is 1:1 or to 2. So you're risking $1 for every $10, and that the trade-off was to either get $1 for every $10 or $2 for every $10. Right, so that's the risk ratio: 1:1, 1:2, 1:3, and where to set your stop loss. So this didn't work out, and defensively speaking, because your stop loss was there to catch the price as it dived down, the overall account that you're working with is well protected. Okay. And I can't say the same for when I started trading. I lost 3 Bitcoin like over a weekend. And sometimes a Bitcoin in a trade and that kind of stuff back in 2018. So I had multiple Bitcoin, and then a bad weekend's trade set me back a couple of Bitcoin, which is obviously big money. And that's because we don't have the same setup as we do now. So whatever exchange you're using, if you're not using a stop loss, this is your call to action to ensure that every single trade that you open gets a stop loss. Okay, never leave it without a stop loss, and don't be greedy with the stop loss. Don't open it right before you entry, because typically what can happen is that price will come down and collect it and then take you out and then move to your target, and that can be super frustrating and so on. So my recommendation again over here is to mark out the significant high or low, have your stop loss behind that, then your entry point outside a kill zone to confirm the turning point direction. Or for example, over here, this could have been a turning point. It didn't look right, so it edged over and came back down. So it would have been unfortunate for anyone who didn't wait to get out of kill zone. So that's what you're trying to avoid with kill zone. So entry goes over here, and then target 1, target 2, target 3, depending on the direction of the market and so on. Okay, I hope that makes sense. So it's about being smart and taking proactive action, of course, but it's also playing defense and making sure that you're not putting too much of your account at risk, especially those who aren't believers in stop losses, and also to ensure that the other components of your trading experience are also responsibly set, like your leverage multiplier, your percentage of account that you're putting in. There's literally a guy called Kelly Criterion who has created mathematical formulas that will either tell you how many trades it'll take for you to go bust if you go too big, or what the correct, on the inverse of that, what the correct position sizing should be for the amount of risk available at that time. So I use the mathematics here of the Kelly Criterion, and I integrated that into the MTOPS, which is why I call it MTOPS Criterion, because MTOPS is the forecasting element. But when it comes to trading, what you want is responsible position sizing in relation to the size of your account, and also not over trading and all those beautiful things, and operating on high risk environments. Like I said, we shouldn't be trading in symmetrical triangles and such, or without confirmed market direction. So in higher risk environments, you shouldn't open up a trade. And how you know whether or not you're in a high risk or low risk environment is by using the MTOPS method. This will give you a score at the bottom, and with that score you can either take action or keep back, I guess, wait for the market to invite you in, which is obviously what you should be doing, like, all the time. The name of the game is to be invited in by the market, to act upon predictable, obvious trades, and not to try to chase everything. Look for your A grade or your A class setups, and protect your capital otherwise. So here's just a great example as to why those things matter. The markets aren't going to be kind to you. It's not its job to be your friend. So with this environment, everyone wants to win. And like I said, the market's like a poker game. If everyone brings $100, 10 people bring $100, and one winner takes all, that means there's only a cap of $1,000 to be taken. So the more people that lose to this, the more there is to gain. And it's just the way it operates. I don't feel guilty about it. So it's just up to you to not be a loser. And by employing these strategies, and also the defensive ones and the long-term stuff like protecting your capital overall, and not chasing trades, managing your emotions, and having the right rule sets and reasons to act when not to act, is going to keep you in the game for as long as you need it to be there. All right, so let's get into the MTOP side of things, the actual forecasting side of things. And again, just check out the Kelly Criterion. It took me about 5 years to learn about the Kelly Criterion. So if you guys are just getting started with trading, you're welcome. You're learning about it straight out the gate. And the information that I offer you is always after ample discernment and ample experience of just shredding away all the rubbish and garbage out there, and just leaving you with what works and what has worked time and time again. So if you're looking for something to validate your trades. Kelly Criterion, guys, you got to look into it. And again, I've turned that mathematics into a workable strategy that coincides with the market. And if things are crumbling, if they look a bit dicey, the score then isn't high enough to open up or suggest a trade. And with that, you can avoid the rubbish setups. For example, what's been happening over here. Okay, let's just get rid of these tools. I guess all of these elements as well. I think there's an object tree or something. I haven't used it for a while. Would it be here? Object tree. Okay, I'm gonna just get rid of it this way. Let's have turning points 1, 2, 3, 4, 5, 6, 7. That's a very early position for a 7. Something to look out for is a double top. Typically, it won't happen inside a symmetrical triangle, but there's not a double top because it's slightly higher and the shape is more V than a U shape. Like a double top, for example, would look like this, although it's not a perfect U shape. I mean, there's no such thing as perfection when it comes to shapes in the market, I suppose. But yeah, a double top will have a kind of a U shape, and then the price being at the same level. So this will be a double top on the lower frame, just by the way. So I do feel that there's too many turning points too soon here. And again, that's because of the symmetrical triangle. The other option is goes 1, 2, 3, 4, 5, a late 5. So let's maybe just get rid of that instead, because of the symmetrical triangle. You're going to find the nearest high that's outside of the symmetrical triangle. And in case I haven't said it enough times, symmetrical triangle. And put 5 there and 6 here. Which is, by the way, it's a good idea just to confirm that it's not a double bottom. And you can see it isn't, because the price is below there. It doesn't flush, and so on. It doesn't sit flushly. Okay, let's rebuild. Hey, don't you start your nuts into your cute little thing. I'm just, for the record, I'm speaking to my puppy. It's my daughter's birthday on Wednesday, turning 2. And I was watching videos of the home birth that we did, obviously, around 2 years ago. And I was bawling my eyes out earlier. So I might have a bit of a husk to my voice for those reasons. Okay, so let's have a look as to where the most likely outcome would be for this. For market structure purposes, I feel that we should block out that segment because of the quadrants. If you don't know about the quadrants, I recommend studying the Unified Theory of Markets, or if you want a much simpler way to learn about how to master the markets, then buy the paid videos and get into my paid community, because it's literally the game changer. Every single student that I've had, within the first 2 weeks, after they've stress tested it and learned how it works, and especially the skeptical ones up front, have all said how incredible the strategy is. Now, obviously, terms and conditions apply, and that is you have to work with this arsehole of a market sometimes. And I'll say that tongue in cheek because what it's trying to do is just achieve correct market structure after a disruption prior to that setup. So this is how it knows how to do that. But for us, it's not great. As I made mention to a few times, it's not tradable conditions, but we want to trade anyway because we just like that by human nature. However, the professionals and those who take the money super seriously and take this super seriously wouldn't have traded through this period. They would have just allowed that to pass over. All right, so I do believe we're in a downtrend overall, but I'm not going to stick my neck out and say that just in case this ranging market decides to do something stupid again and then go in the upside direction. So I'm going to just put, so let me take it a step back. The rule with dominant trend direction is to commit to a trend direction until proven otherwise. Otherwise, you'll be too afraid to do anything because you'll always be wondering or concerned that there's going to be a flip in the market and you're going to be wrong. So to overcome that fear of non-action, my recommendation is just to lean into the market. I know it's quite contradictory because of these symmetrical shapes and kind of non-periodic times, but just lean into the direction of the market until it's no longer that way. So just trust that this is a downtrend now. The reason being is because this high is lower than that high. So lower highs, lower lows turns it into a downtrend. So just believe it's a downtrend until you're proven otherwise. And again, the reason for that is so you don't get stunned or caught up in non-action. Less talking, let me just kind of try utilize the last 3 minutes and set up this guy real quick. But yeah, I hope that makes sense, and I hope that the shared information and experience in these videos are helping you become better traders in some way or another. As there wasn't anyone to guide me, unfortunately, the people I did follow were clueless. I learned only afterwards, and they couldn't provide anywhere as good a result as I've been able to create for myself and now sharing with you guys. Okay, so it's 1, 2, and again, I don't always have to be right, but it's also good to have the knowledge of what to do when things aren't going right. So it's super important to work with that as well. I want to extend, hold on a sec. So it's 20.1, 2, 3, 4, 5. We can do a 6, 7, 8. Let me just investigate, see what I did there. Yeah, that kind of works. So I'm just going to do a bit of a, I'm not obviously recommending trading over this time. We're trying to ascertain dominant trend direction and still early over here. Let's see if this doesn't break. So what you should be looking for is if this doesn't break that high, then you buy high, sell low. And if you don't know how to do shorting of the market or don't understand how it works, leave a comment on the video and then I'll get around to explaining that in a future video. Okay, that looks good. I just want to nudge it so it's on that progression line over there. I could keep that going, but we're running out of time, so let me just do a quick forecast for you. Assuming that it's going to be a downtrend on the higher frame, I don't think there's too much energy left in this transition, so just keep an eye out for a turning point, confirmed turning point that is, and a move down. So what I'm talking about is like something either there or there, 15 seconds, go on, or there, and then if it doesn't make it past that higher point, then buy high, sell low.